Hi, I am Christine Schumack, Vice President Controller of the USO. I wanted to begin the finance section by giving a high-level overview of the financial structure and elements of the USO. The USO is a tax-exempt organization under the United States Internal Revenue Code Provision 501(c). This means that we are organized and operated exclusively for our established purpose for which we are tax-exempt. If we engage in activities that are outside our established purpose, there may be tax implications. There are 26 IRS tax-exempt codes. We fall under Code 3, which is a charitable organization. This means that we are required to receive at least 1/3 of our support from the general public. We are also non-political in nature. We have annual filings to ensure that we comply with our financial requirements. We were required to have an annual independent A-133 audit related to the government funding that we received. In conjunction with this, we engage in an annual financial statement audit. These audits are performed by our outside independent accountants. We also are required to annually file the IRS Form 990. This is the organization's public face document. It discloses financial and programmatic information about the organization. It is the document that allows the IRS to provide governance and ensure that we are following the code and our exempt purpose requirements. Because we are a charity receiving donations from the public, we are scrutinized and evaluated by charity watchdog organizations. There are many different charity watchdog organizations, and on this slide, a few of the well-known ones are listed: Charity Navigator, Better Business Bureau Wise Giving Alliance, and AIP, American Institute of Philanthropy. Currently, we are 3 out of 4 stars under the Charity Navigator rating scale. The challenges of the various charity watchdog organizations are that each of them have different rating scales and includes or excludes different items when calculating metrics. I will discuss some of these challenges on the next slide. I will now discuss the key financial ratios that are used to measure how well a charity operates. I basically will discuss 2 of these. There's many other ones that organizations might look at to see how we are doing. One of the main ratios that charity evaluators look at is the efficiency ratios, on how we are spending our resources. Expenses are divided into 3 broad categories: program, fundraising, and management in general. The efficiency ratio relates to the program expenses as a percent of our total expenses. On an audited financial statement basis, we spend 88% of our resources on program-related activities. The IRS has a slightly different methodology of calculating our program efficiency in the fact that they exclude certain contributed services, such as the value of the USO's celebrity entertainment and public service announcements. The exclusion of these donated services results in a lower program efficiency ratio. On this basis, our program efficiency is approximately 74%. We believe that the USO's audited GAAP financial statements is a more appropriate metric for determining the efficiency ratio, the 88%, because it recognizes the important value these contributed services and goods have on the USO's mission to support troops and families. This broad scope of goodness to troops and their families would not be feasible without the in-kind service donation of our volunteers and entertainers, the contributed goods we received, and the value of the donated public service announcements' effect on public awareness of our mission. Just as a data point, the BBB Wise Giving Alliance states that the charity should spend at least 65% of its total expenses on program activities. Under both calculations, we meet this standard. Another ratio that is used in measuring a charity's operations is the fundraising ratio, or cost to raise a dollar. Our fundraising efficiency is 81%, meaning that we spend 19 cents to raise a dollar. BBB Wise Giving Alliance states that you should spend no more than 35 cents to raise a dollar. All of our centers and offices, Arlington, overseas, or chartered, operate under the same brand, strive toward the same mission to lift the spirits of America's troops and their families, and aim to use our financial resources to maximize the utility that we provide to the troops. Next, I will present an overview of internal controls and your responsibilities related to it. What is internal control? It is the process to provide reasonable assurance of the reliability and integrity of financial information, the effectiveness and efficiency of operations, the compliance with policies, plans, laws, and regulations, and the safeguarding of assets. There are three types of controls: preventive, detective, and corrective. Detection usually measures the effectiveness of the preventive controls. Correction controls usually consist of correction action plans to correct breakdowns in controls exposed by detection controls. Internal controls are important because they protect the organization, as well as our employees. They protect our resources and our reputation and brand. They protect us from accusations. This is a great way to think about internal controls. All the time I hear, "I trust my employees," or "oh, that situation would never happen." Internal control is not about trust. It's about protection and control. I urge you to look at your job responsibilities and assess where there are areas or tasks that you have where you may have too much control or could possibly be accused of something. You should want controls around the activities you perform to protect yourself and, in turn, the organization. Finance should be used as a resource when questions or concerns about internal controls arise. Who is responsible for internal controls? Everyone. It's not just accounting personnel. If you notice irregularities or something that doesn't seem right, or could be performed better, you should point it out to your supervisor or finance. This slide presents an overview of some basic and discipline controls. Basic controls: documentation, authorization, approval, record keeping, physical access, independent reconciliation. Discipline controls: supervision, segregation of duties, and rotation of duties. Next, I will touch a little bit on segregation of duties. It is a control that we hear about all the time, but really, what is it and how can you achieve it? This is extremely important, especially in locations where cash is received. In order to achieve segregation of duties, the four following functions must be separated: authorization, custody of assets, record keeping, and reconciliation. This shows that you really need 4 employees doing these separate functions. But many centers do not have that many employees, so segregation of duties cannot be achieved. This is where mitigating controls come into play. These are controls that are established to mitigate misappropriation when basic controls cannot be achieved. An example is if a center accountant records cash receipts and reconciles the bank statement, therefore performing the record keeping and reconciliation function. A mitigating control would be for the center director to review the bank reconciliation or receive the bank statement first before giving to the accountant to reconcile, to scan through to see if there's any unusual items. Lastly, these are some considerations regarding internal control to think about in your daily job function. Is the information, form, data accurate and complete? Is there a better way to do your job? Is this legal and right? Does it look wrong? Would someone else think so? Are you following established procedures? And then could anyone take or gain access to items that